Hi, my name is Roger Schlueter. This video is actually about basically human nature and the choice of interest rate options. And really, the choice of an interest rate option can sometimes have profound implications on your business loan payments and your future business success. This video is really about the choice of an interest rate and the influence of human nature on that choice. If you stay till the end, I will tell you what the correct answer should be, at least that I think. Of course, we could all have our own opinions. Anyway, the choice of an interest rate, usually for a business loan, the bank or finance company will give you basically two options. And they have a lot of variations from these, but basically two options. Your business can have a variable rate for a period of time, usually like 1 to 5 years. Utilizing this option, the rate will go up and down with a benchmark rate. The benchmark rate would most likely be prime rate or the 10-year treasury rate. Your interest rate would be set as to a certain percentage above your benchmark and then go up and down basically with that benchmark rate as rates go up and down. Business loans have really no limit on the direction of the interest rate, either up or down, unless you have negotiated caps or floors on your interest rate. Now, the bank will have floors. It does not want your rate to go to zero. So usually they'll have, when rates start going down, if they give you a variable rate, they're going to say, oh, it can go up forever. They'll like that. But when it goes down, let's say, they'll have a cap on the downward movement of like 3 or 4%, and it can't go any lower than that because they're going to make some money on it. They're not going to let you have like zero interest. So anyway, cap would be a limit on the upward movement of an interest rate within the loan term, and a floor would be the opposite, a limit on the downward movement of that interest rate within the loan term. I'll give you an example. This is early 2023. The prime rate right now is about 8%. And this is the rate the bank would charge its best customers and or most profitable customers. Now, you could be a best customer. You could be a most profitable customer, but if you're listening to this video, I kind of doubt it. So anyway, you could be though. So anyway, the rate would most likely be approximately 2% over that prime rate, or 10%. This rate would be for a period of time of 1 to 5 years. The loan was most likely not have a prepayment penalty because the interest rate is variable and usually proposes less rate risk than a fixed interest rate loan. Most SBA 7A loans are based on a variable rate. The loan would be renewed at the end of the term, that 1 to 5 year term, and then it would have the chance to you'd have the chance to change the rate and term if the bank would do that. So anyway, that's the first option. The second option would really be to fix the rate for a period of time. And usually banks want to fix it for like 3 to 5 years. They can do it for less than that, but usually 3 to 5. This fixed interest rate would depend on the direction of interest rates and the direction of the economy at the time that the loan was closed. Banks would be more likely to want you to fix an interest rate when rates are trending downward, because they basically will have a floor there, and as rates go down, they're making more money than they would if they had to redeploy that money. So anyway, and would be more likely to give you a variable rate, when rates are trending upward. The reason for this is that banks are in business to make money. The fixed rate in a declining environment would keep the bank interest or rate, would keep it high as it was trending down. And the banks, on the other hand, would not want to fix the rate when rates are headed upward. They really instead would want to ride those rates higher, which would mean more profit for the bank. There is a lost opportunity cost to lending money out at a fixed rate, just to find out later that you could have lent the money out at a lot higher rate. So really, banks are very cognizant of that. They really are aware of it, definitely. An example of this would be in the 70s where you had the savings and loans, and you had a whole bunch of them go out of business in the 70s. And it's basically because they had all these low fixed rate housing loans, and that were like, I think a lot of them were very low depending on when they did them, but they were low rates. And then in the 70s, if you remember, that's when rates, inflation was high, and rates got, actually I think rates in the early 80 or something, they got up to 21% or something like that. So anyway, that caused a real problem for them, because they had all these loans that weren't making any money, and the actual cost of money was very, very high. So anyway, so that's where rising rates and fixed rates, at a much lower rate. Most banks will fix the rate for a period of 3 to 5, and then they'll amortize the loan for a period of like 20 years. And then the loan will mature at the end of the 3 to 5 year term, and then the bank will renew the loan for another 3 to 5 years, or renew it for whatever term and rate, that suits them and suits you, whatever you negotiate. The correct way to really pick a loan interest rate depends on whether rates are low or high. And human nature has a way of doing this. Most people will not fix a rate when rates are low. And that's because they think the rates will be low forever. They're low now, they're going to be low for a while. I don't need to fix this rate. Or they think there's no need, at the time. The really correct way is to go ahead and fix the loan interest rate when rates are low. So if rates are low and you're getting a loan, you want to fix it for as long as you can, because rates, generally do change. Sometimes they can be low or high for a long period of time, but a lot of times they do change over time. The opposite is true when rates are high. Most people want to fix the business loan rate because rates are high, and they fear that higher rates in the future, they're just going to keep going up and up and up. So they want to go ahead and fix that rate. The really correct way to do it would be when rates are high, and I mean historically talking high rates, then would be to get a variable rate. And then when rates are high, and you'll be able to ride those rates lower as the rates start going down. So fix your rate when rates are low, get a variable rate when rates are high. There have been studies done in certain periods of time where a variable rate really wasn't that bad if rates are going up and down. If rates are going one direction, then that could be, it could be bad. So anyway, thank you very much. My name is Roger Schlueter. And if you got anything out of this, I hope you subscribe and like the video, and hit the notification bell if you want to see future videos. My name is Roger Schlueter, and I will see you in the next video. Thanks.